Hello everyone, welcome back to CR Investors' ongoing tutorial series on learning technical analysis. Today's tutorial subject is all about fibs, or what we call Fibonacci levels. This tutorial in particular, this is part one of a two-part series, and as you can see on the slide, we're going to look at what are called retracements today. My name is Brian Beamish. I am the Canadian Rational Investor, and feel free to look at all the different videos on learning technical analysis and learn how I use all of these tools in my daily trading experiences. As always, you can see there's a nice link here on this slideshow here. You are encouraged to pull down this slideshow presentation and follow along in person. That way you can actually look at the charts and the notes in detail and zoom in if you have to, versus just watching the YouTube presentation. But if you can't or you don't want to go that route, you're more than welcome to pop over to my website, therationalinvestor.ca, and follow the links through the seminars, and you'll see all of these tutorial slideshows there as well. So let's get moving. You know, these tutorials are about 10-15 minutes long, so let's try and keep on page here. So moving right along. What are we going to cover today? Obviously, as the Fibs tutorial, the topics we're going to cover. First, we're going to define what Fibonacci levels are. Maybe take a moment or two and talk about Mr. Fibonacci himself. We're going to look at the three key components for retracements. Number one, we're in range markets here. We're not in trending markets. Number two, we're going to look at what's called the first stop target. That's 38.2 fib. And then number three, we're going to look at the concept of the optimal trade entry, or OTE zone, and the sweet spot. And that's the midpoint of that zone. We're going to finish off this series, or I guess this tutorial in particular, looking at what the concept of institutional order blocks and understanding where they usually occur. You know, basically how institutions use fib levels, and coincidentally they happen to line up with these OTEs quite often. And then we're going to finish this tutorial with just a simple example of how I use this fibs. I use the fibs specifically in retracement mode for trading range markets. So let's get moving. All right, so some definitions. Fibs, you often hear people talk about fibs, stands for Fibonacci retracement levels. Fibs are based on the key numbers identified by mathematician Leonardo Fibonacci in the 13th century. The Fibonacci sequence of numbers is not as important as the mathematical relationships expressed as ratios between the numbers in the series. In technical analysis, Fibonacci retracement is created by taking two extreme points, usually a major peak or trough, on a stock chart and dividing the vertical distance by the key Fibonacci ratios, 23.6, 38.2, 50%, and you often see 50% included, but ironically enough, 50% is not a fib level, but for the purposes of this seminar, we'll include it. The 61.8, 78.6, and 100% levels. You know, there are other fib ratio levels that are important. You know, one that jumps out at me, 88.6. But for the purposes of this tutorial, we're just going to stick with these simple ones. I mean, the keys that we really want to concentrate on are 38.2, 61.8, 78.6. And then, of course, as we said just a moment ago, the midpoint between the 61.8 and 78.6 is super important, and that's called the sweet spot. But anyway, once these levels are identified, horizontal lines are drawn and used to identify possible support and resistance levels. Really, it's just that simple. These ratios seem to play an important role in the stock market, just as they do in nature. and can be used to determine critical points that cause an asset's price to reverse. The direction of the prior trend is likely to continue once the price of an asset has retraced to one of these ratios listed above. As always, I'm always going to include a web reference, as you can see down at the bottom of this slide. So if you'd like to dig into Fibonacci retracements a little bit more, Investopedia is a very good site for learning technical analysis and key terms, and you're more than welcome to pop over here just to confirm my definitions. And like I said, if you want to do a little bit further digging on your own, you're more than welcome. All right, moving right along. So we're going to, at this point, take a look at the three really important points of the Fibonacci retracement idea. I've basically just pulled up a chart here of the S&P 500. This is the ETF, or Exchange Traded Fund. SPY, it's the most liquid traded ETF in the world, and basically it's a nice benchmark for world equity prices, so I use this SPY Spider ETF quite a bit, and so do technicians. So first off, we're going to talk a bit about range markets. So as you can see from this chart, we have a low of the range, and on this guy in particular, it's right around 101, 102. In fact, we have 101.13 right here as the bottom of the range. And price basically in a nice bull market went room straight up to 137.18. This is a fairly substantial move. I mean, basically that's a 30%, almost 40% increase in this asset's price. So, just like the rubber band theory in life, I mean, you can only stretch the rubber band so far before it has to sort of snap back, come back to reality. The question ultimately is, okay, so, we've had this big move. Where is market likely to retrace to if this underlying bull market is still intact? And the long and short of it here is that's how we use the fibs for ranging markets, is that we believe ultimately this is a bull market, and what we're looking for is a pullback of this range, and where are likely stopping points. All right, so number 2 point here, first stop targets, 38.2 retracements. Now, what I find really interesting about technical analysis is that, here's the 38.2 retracement here. You can see, even before we've identified what the entire range is, you can see that ahead of time, people had quite a bit of interest in this 38.2 level. So price went zooming up and just, failed just underneath it. And then we went up and blasted through it. Then, we topped out. We came back down. We turned just above it. There's the ultimate high. Then we came back down and turned just above it again, tested those highs, came back down. You can see this one candle here, price went zooming all the way down, but look where it finished, right around this 38.2. Next candle opened up higher and came back down again, zoomed all the way down, but look how price kept being drawn right back to this 38.2. So on all of my charts, whenever I'm looking for, okay, where's sort of the first place that we should be looking to see whether this market is basically continuing this uptrend, and it's going to keep going and going and going, and basically this 38.2, I call it my first stop target. I mean, it is almost always respected. It's quite remarkable to watch. So if you get to the point where you've drawn a lot of fibs off of these ranges, you're just going to find that this 38.2 is a very, very significant level. All right, moving right along. Point number 3 here is the optimal trade entry, or OTE, zone, and the sweet spot, 70.5%, which we said was the midpoint between these two important fibs. So we look at the trend again. Boom, big move up in price. We draw our fib retracement levels, and we say, okay, where is it likely that this market's going to pull back? And OTE, optimal trade entry, in this case, the optimal trade entry zone for long or buying this bull market is, as we said, is right between the 61.8 fib and the 78.6 fib. And technicians and especially institutions, they pay special attention to this midpoint of this green box. See, there's an optimal trade entry OTE zone, and that's this 70.5, right? Now, is 70.5 itself a Fibonacci number? No, it isn't. But this OTE level, the sweet spot level, beg your pardon, is really important to technicians. So, what's fascinating here is you can see price basically moved up. It consolidated above our first stop target. It broke down. So, if you're thinking, okay, here's the bull market, there's the double bottom right there. What a coincidence that the original double bottom breakout happened to be right in this zone. Do you see that? I mean, it's incredible how this stuff lines up over time. So anyway, long and short of it here, price comes zooming down. We fought with the 38.2. It let that go. Went blowing through the 50% level, came down to the 61.8, and look how it just literally went right to the 70.5 and then reversed. And the bottom line here is, for technicians, we will believe that this bull market is healthy, and it is a bull, if this 78.6 level, or the bottom of the OTE zone, remains intact. If that gets violated, we close below there, then that puts this entire bull run into question. You can see how price basically came into the OTE zone. So if you had your open order just sitting down here at the sweet spot, look how much heat you took on this trade. You took almost no heat on this trade whatsoever. Price quickly gyrated back up, tagged 38.2, and you can see how, the market basically said, okay, am I bullish? Do I really want to be bullish? And it tested, So if you had bought up here, the market was basically trying to flush you out down here. But if you had been nice and patient and just worked your open orders to buy down into the OTE zone, you really didn't take a heck of a lot of heat on this trade. And as you can see, the trade ultimately resumed its upmarch, and away it goes. So, excellent example of basically an established range, drawing the fibs off of the range, understanding why market topped out at this 38.2, and if I was an institution or I was a smart investor, where would I most likely want to be buying this big bull run? All right, that's quite a bit of information. Hopefully that isn't too confusing, but I think this is fairly straightforward. Okay, so here's the flip side example, and what we're going to look at now is the concept of institutional order blocks and using the optimal trade entry to confirm those institutional order blocks. So institutions, not retail, right? They're the ones that put in market tops and bottoms. Retail just simply does not have the purchasing power to do that. Counter trend rallies into tops or bottoms are often good trade locations because institutions have a vested interest in defending those areas where they turn the market. So in our example here, we're just looking at this as the QQQs, or basically the ETF on the NASDAQ. You can see the market topped out here at about 55, came screaming down here to 41, which is basically about a 20-25% correction. So, if you believe that this is a bear market, right, a nice big meltdown here, where, number one, would the most likely place be for the market to run out of gas if we happen to have a counter trend rally? And does that area, and that's this concept of the OTE, right, the optimal trade entry, and there's our short sweet spot right there at 50.92. Does this area happen to correspond with any price action on the charts that actually maybe looks like where institutions stopped a bull run and started a bear run? So as you can see, over here on the left-hand side through this May, June, September period, prices were moving higher, and the market was in a bull phase. Higher highs, higher lows, bull market. Something happened here through this September, October, November period where price stopped making new highs, and you can actually see over this 3 or 4, and I think this is a weekly chart. Yeah, it's a weekly chart. So over this 3 or 4 week period, somebody stepped in and said, "Thou shalt not make a new high. Thou shalt make new lows," right? So we have, if you follow my market structure concept, you see that we have an M top here, right? So price rallied, then came back down, then rallied back up to test these highs, and then failed. So in essence, and you could argue that we have even a bigger M right here. Market rallied, sold off, counter trend rally, broke down. So long and short of it here is that institutions decided that the market shall not go higher here. They probably spent a lot of money shorting the market in this area to stop the bull run. So as a result, they have a vested interest in defending this area. This is basically where they're short, and they don't want to see price go any higher than that. So price, like we said, topped out, came screaming down. Now, understanding that, okay, maybe we have a new bear market working, do you want to go and sell this thing at $41, $42? Simple answer is no. You ideally, if you do want to be short, you want to draw your fibs, understanding that this is the trading range, and identify this OTE zone. If I am going to short, this is where I want to short this market from. And what a coincidence, this OTE zone just so happens to be within this institutional order block area where institutions stop the previous rally. So as you can see, price basically, and this is a weekly chart, right? So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks, right? So that's what, 2.5 months, almost 3 months. Price just slowly climbed higher, right up into the OTE zone, just missed the sweet spot by just a hair. And you can see how when the market rallied up into this area, all these wicks at the top of these candles, every time price got up into this area, boom, they rejected it. Boom, they rejected it. Boom, they rejected it. So clearly you can see that once we got into this OTE zone, institutions said, all right, time to short, let's knock this thing back down. It took several weeks of that selling to ultimately end this sort of bullish enthusiasm, and we rolled back over, and sure enough, this institutional order block level was defended, and it just so happened to be right into an OTE zone. So if you're using fibs, great idea to try and incorporate this OTE concept into your trading, and then couple it with, okay, where was that previous top? In this example, it's a bear market. So where was that previous top, and does it happen to line up with OTE levels? I mean, this is called the optimal trade entry zone. Well, not a coincidence. If you got the opportunity to short against these highs, that would be an optimal trade entry. Just going back a moment to look at the last slide, we can see how, and the note here is, this was a bull market, and we just simply say institutions do not buy on the way up. They see this bull market and they say, okay, we want to buy. Where are we going to buy? Well, if we're going to buy this thing, we're going to buy it where we have a vested interest in defending it. And as we said, if you saw this chart previously, you'd see that it was making lower highs and lower lows. So the institutions came in, they stopped the bear market. they turned the market, and they turned it actually into a bull market. So they have a vested interest in defending this area. Basically, the institutions will defend their purchases. What a coincidence. And we even pointed out before that the double bottom breakout level itself just so happened to be right at the OTE long sweet spot. Now, interesting, when you see price came down, every time it came down into this area where the institutions put in the bottom, it was quickly rejected, quickly rejected, quickly rejected. Even here, rejected. Even here, rejected. I mean, price just did not want to spend time down here because the institutions, they had absolutely no interest to see price down here. Sure enough, this was a bull, and the trend resumed. All right, so how do we incorporate the fibs, and this is the last part of our tutorial here, how do we incorporate the fibs into our day-to-day trading? So what I've said here, incorporating OTEs into your trading plan can greatly improve trade location. And that's really what we're talking about when we use fibs, is we're talking about trade location. It's not a good idea to be buying way up top here. In this example, this is the bond market, the TLTs. You really had it wasn't in your best interest to be buying at 94, 95, 96. Where should you have been considering buying? If you couple this concept of the OTE, the optimal trade entry, with the institutional order block, where the market was stopped going down previously, institutions put in a bottom and turned it, so basically they have a vested interest in defending this area, you come up with very, very powerful trading tools. If one adds momentum and volume study, potential pivot points seem to jump out to technicians. So again, here's the bull rally. Here's the range pullback, right, our retracement. And gee whiz, look what happens to come in here right in that zone. Remember we said 78.6 fib is our sort of line in the sand. If this is indeed a bull market, that area will be defended. You can see here's the institutional order block. So basically anytime price got into this area, the institution said, not going down anymore. Let's turn it around. And sure enough, a beautiful double bottom came in. We see that the volume, indicator here turned. Nice double bottom there. We got a nice double bottom on the MACD, and it turned. And gee whiz, what a coincidence! Our overbought, oversold indicator put in a nice double bottom near the oversold condition. So, fibs, institutional order blocks, volume analysis, momentum analysis, put it all together, not a bad trading idea, and sure enough, just basically going long in this area turned out to be the right trade. Last thing I'll mention, and I basically mention this on all of my tutorials, is that these opportunities would never reveal themselves through price analysis alone. So if you just wiped out all the fibs and you wiped out all these indicators and moving averages and you were just looking at price, you'd probably be pretty bearish through here, and you wouldn't actually identify the fact that this was an area of buying interest, not selling interest, until it was just too late. So, when used in conjunction with momentum and volume, OTEs are a powerful trading tool within a ranging market. And the long and short of it here is, I highly encourage people to layer their indicators, use multiple signals. The OTEs, coupled with the candlestick tutorial, if you want to take that, fabulous tools to judge price action, and then couple that with momentum analysis and then volume analysis, and you got yourself one heck of a cool trading plan. All right, so that basically brings us to the end of this tutorial, understanding and using fibs in a ranging market. As I said before, you're more than welcome to pull down this slideshow and keep it for yourself. I would appreciate you don't copy or redistribute it without acknowledgement to me. You're more than welcome to go to the website and dig around there. Tons and tons of information for you to all access for free in the seminar section of the website. And as always, feel free to follow me on Twitter at CRInvestor, and then that way you can get updated as any of this information comes along through your Twitter feed. So I hope you enjoyed this presentation. Basically, we're at the end. This is part 1 of the Fibs tutorial, so I would encourage you to take a look at part 2 of the tutorial, which will be examining trending markets and how you use Fibs to help you understand trending markets. But regardless, I wish you all the best. I hope you've enjoyed the material, and I wish you all the best in your trading, and have yourself an awesome day. Thanks again, and talk to you soon. Bye now.